Hey everyone, I recently read a very interesting research report by Goldman Sachs titled Finding Alpha Ideas Amid a Cyclical Slowdown. So Goldman Sachs research team believe that the current correction in the Indian stock market is cyclical rather than structural. This report highlighted some key reasons for slowdown in Indian GDP. It include your fiscal tightening by Indian government mainly to reduce fiscal deficit and ensure economic stability. This fiscal tightening was mainly done via rationalizing the government spending on infra and capex. Second is monetary tightening by RBI mainly to control inflation and provide financial stability. This was done by increasing the interest rate, as higher interest rates lead to higher borrowing costs for businesses and consumer, eventually slowing down investment and consumption. That cools down the inflation problem. So RBI also implemented credit regulation like tightening the norms on unsecured loans like microfinance, mainly to reduce systemic risk and prevent credit bubbles that could destabilize the financial system. In short, both government and RBI took some key measures to ensure economic stability in the country. Such measures, when taken, impact economic growth for short term, but they are important from a long-term stability viewpoint. And that's where Goldman team believes that Indian macros are very strong and this correction is cyclical rather than structural. Now recently both Indian government and RBI have taken measures to revive this GDP growth. For instance, Indian government has announced zero tax up to income of 12 lakh rupees starting this financial year. And RBI has cut down the interest rate by 25 basis points in February month from 6.5 to 6.25%. This was the first rate cut since August 2023. It is expected that there can be further rate cuts by RBI in 2025. Also, RBI is injecting liquidity via purchase of government bond. During January-February 25, RBI purchased G-Secs worth 60,000 crore. In March 25, it again announced purchase of G-Secs worth 1 lakh crore. So these efforts by both government and RBI are expected to revive the GDP growth in FY 25-26. And that's where Goldman Sachs research team believes that the worst is likely behind us in terms of economic growth and earning trajectory, and stock prices have corrected meaningfully. Although they still see higher market volatility in the near term due to elevated domestic positioning in mid and small cap space and ongoing global uncertainty from tariff war from Trump. Having said this, they have identified 9 stocks that have strong tailwind within their respective sectors and have the potential to deliver strong returns over the next 12 months due to either positive catalyst or healthy EPS growth momentum. Overall, these stocks offer an upside up to 25% on an average over the next 12 months. So over the next 10-15 minutes, we'll discuss these stocks and reason behind the selection. Before we begin, let me clarify that the intention behind this video is to share knowledge. Do not consider it as a buy or sell tip. Kindly do your own research before investing your money. Also, during volatile market like what we are seeing right now, it is very important to stay on top of your portfolio's performance. Just checking the overall percentage return on your portfolio is not enough. You need to keep a tab on any diversification risk that your portfolio may have and how well it is performing against the benchmark and many other things. Now, one app that can actually help you with a detailed analysis of all this is Deserves Wealth Monitor, our partner in today's video. I've been using this app for quite some time now and is already well known for mutual fund portfolio analysis it provides. I'm sure some of you may have used the app as well. Now they have launched a stock portfolio analysis feature. You can connect all your stock holding even from multiple demat accounts and track them in one place altogether. One analysis that stood out for me was where it categorized all my stocks into large, mid and small cap along with a comparison against the benchmark performance. This, in my opinion, is super helpful in understanding how your stock portfolio is performing and whether you are over or under diversified in certain sector. I highly recommend checking it out if you want a clearer picture of your stock portfolio's performance. Link is in the description below. Alright, let's get started with the stock picks from Goldman team. So first 2 stocks in the list are from financial sector. Financial sector has been underperforming over the last few years due to many factors, including tighter regulation from RBI, slower deposit and credit growth, poor liquidity conditions, and concern around asset quality, especially in unsecured lending. However, the recent measures by government and RBI, including tax rate cut, CRR cut, liquidity injection in the economy, rollback of risk weight on lending by NBFC are positive signs for financial sector. Plus, the valuations are very reasonable in this space. So, financial sector stocks should see valuation re-rating. That's where the first pick of Goldman team is HDFC Bank. There are 5 factors behind the selection. First, HDFC Bank has demonstrated a solid gain in the market share in deposits during the first 9 months of FY25, with an incremental deposit market share of 16% as compared to its outstanding deposit market share of 12%. This indicates that HDFC Bank has been capturing a larger portion of new deposit growth in Indian banking system and outpacing competitors in attracting fresh deposits. Second reason is pre-provision operating profit ROA moderation under control despite sharp reduction in loan to deposit ratio. So after integration of HDFC Limited, HDFC Bank loan to deposit ratio spiked to 110% in Q3 of FY23 due to HDFC Limited loan heavy portfolio. That's where HDFC Bank took a deliberate effort to grow deposit faster than loan. And now HDFC Bank loan to deposit ratio has fallen to 98% in Q3 of FY25. Despite this reduction, HDFC Bank was able to manage pre-provision operating profit return on asset from pre-merger level of 1.9 to 2% to now at 1.6 to 1.7%. This reflects bank ability to manage profitability and operational efficiency during the strategic shift towards deposit mobilization after its merger with HDFC Limited in 2023. Third factor is loan growth in core segment such as retail and commercial and rural banking remain ahead of the industry, reinforcing HDFC Bank competitive edge in these high yield, high demand area. Fourth factor, accelerating market share gain in credit card business. HDFC Bank holds the largest share in credit card market in India with approx 20 to 21% of outstanding cards and 25 to 27% of credit card spending as of September 24. And bank is able to maintain this leadership. And fifth factor is stable asset quality during this challenging macro environment. So based on all the calculation, research team of Goldman has given a target of 2090 rupee on HDFC Bank. That implies around 12% upside from current levels. Second stock in the list is AU Small Finance. In last 1 year, AU Small Finance has underperformed Bank Nifty on concern over profitability given near-term challenges in macro environment and increased NPA in unsecured lending of microfinance and credit card. However, Goldman research team believes that AU will likely start delivering a strong growth momentum in second half of FY26 as loan losses in microfinance and credit card peaks out. AU Small Finance is expected to grow its loan book at 21% CAGR between FY24 to 27. Deposit growth is expected to grow at 23% CAGR during same period, and they expect the bank to deliver earning growth of 31% during FY25 to 27. AU Small Finance has healthy asset quality in its core portfolio, and based on that, research team has given a target of 796 rupee on AU Small Finance, implying an upside of around 40% from current levels. Next two stocks are from consumer sector. Again, consumer sector stocks have underperformed for a long time, mainly due to slowdown in earning growth driven by high food inflation and slowdown in unsecured consumer credit, both of which impact low-income urban consumers. Also, there were certain one-off factors like extreme weather condition in H1 of FY25. Although the food inflation has started to moderate gradually in last couple of months and expected to further reduce in near future. Also, the income tax rate cut should benefit the consumer demand in the country. That's where the first pick of Goldman report from consumption sector that can potentially outperform is Titan. Titan is India's leading jewelry retailer which addresses the affluent Indian consumption opportunity. Company has consistently gained market share in last many years from increasing consumer shift from unorganized mom and pop jewelers to branded jewelry chains. And this trend is expected to sustain. Goldman research team expect Titan's standalone EBIT margin to grow at 18% CAGR over FY25 to 27 compared to 6.2% CAGR over FY23 to 25. Overall, they have given a target of 3,900 on Titan that implies an upside of around 20% from current levels. Second stock from consumption theme is Godrej Consumer Product. Godrej Consumer is a leading home and personal care company in India which also has international business in Indonesia and Africa. So first reason for selecting Godrej Consumer is potential market share gain due to new formulation. For instance, after a 3-year regulatory process, Godrej Consumer has got approval to launch its mosquito repellent molecule RNF in the incense stick format in January 24 and in liquid vaporizer in July 24. Company claims 2 times higher efficacy for new molecule as compared to the old one. this product superiority will likely take a few years to replicate for other competitors given timeline for the registration process for new molecule in India. Then second reason is sustained high growth in air care and fabric care, and third factor is recovery in EBITDA margin. Godrej Consumer gross margin have seen a sharp decline in Q3 of FY25 driven by a sharp increase in key input cost, palm oil. While palm oil price remains elevated, the soap industry is implementing 3 to 5% price increase every quarter that would be passed on over a period of 2 to 3 quarters. So margins would gradually recover. They have given a target of 1370 on Godrej Consumer. That implies an upside of around 13% from current levels. Next two stocks are from infrastructure sector. First is Adani Port. In last 6 months, Adani Port has significantly underperformed the index mainly due to weaker than expected cargo run rate and uncertainty around global trade due to any potential tariff. However, after the correction, stock is trading near its long-term median valuation. Adani Port is India's largest private port company with 27% market share as of FY24. Goldman research team believes that Adani Port FY26 growth outlook is looking better than FY25. Plus, the valuations are reasonable. Couple of risks in the growth thesis include increasing exposure to international port and capex remain at elevated level. Overall, they think the risk rewards are much favorable and have given a buy call on company with a target price of 1400. That implies around 15% upside from current level. Then second stock is Interglobe Aviation that holds around 65% of India's aviation market, which is up from 48% during February 20 period. They believe that Indigo would be able to sustain this market share due to their healthy new plane deliveries and large outstanding order with Airbus. Also, airline industry is consolidating towards two large players, Indigo and Tata Group, which will likely improve pricing discipline. Third factor is Indigo's cost leadership, which will likely drive improvement in profitability. And fourth factor is international business has a long runway for growth. A few risks for Indigos include spike in oil price that could hurt profitability along with INR depreciation and capacity addition delays. Overall, they have given a buy call with a 12-month target price of 5,050. However, Indigo is already trading at similar levels, so not much upside based on current target price. The key reason for lower target is based on assumption of RASK to CASK compression. Please note that it is a very important profitability metric for Indigo, where RASK is revenue per available seat kilometer and CASK is cost per available seat kilometer. When the RASK is higher than CASK, Indigo makes profit. However, there have been cases where a lot of Indigo aircrafts been grounded in the past due to technical problem. That resulted in reduced capacity utilization and higher maintenance cost. Plus, fuel cost is extremely volatile that highly impact the CASK. So, in case Indigo can deliver RASK to CASK ratio of 60 paisa against current estimate of 50 paisa, the target price would be 5,500. Then seventh stock in the list is Mahindra & Mahindra. Of late, Indian auto sector has been facing some headwinds due to concern over fall in auto sector demand, potential reduction in import duty on cars, and increasing competition from likes of Tesla and BYD, and recent tariff hike by US on auto industry. In this context, Goldman research team like Mahindra & Mahindra that offers exposure to more stable and durable themes of premiumization and rural consumption pickup from domestic Indian market. Within premiumization theme, Mahindra & Mahindra only caters to SUV segment in the car business, which is growing at a much faster pace in India. In FY25, India's SUV market volume has grown 13% year-on-year versus small car market volume which has declined by 20% year-on-year. Then second reason is Mahindra & Mahindra offer better car volume growth visibility as compared to peers because of strong product pipeline and large order backlog and wait period on models like Thar Roxx, XUV 700, then XUV 3XO, and recently launched battery EV cars, which is BE6 and XEV 9E. Mahindra & Mahindra collectively offer much better car volume growth visibility in FY26 as compared to peers. Also, its tractor division, where it has 40% plus market share, is doing very well. Mahindra & Mahindra has been gaining market share in tractor industry due to its introduction of lower horsepower models. Also, tractors are 2 times more profitable than automotive segment. Based on that, research team has given a target of 3,800 on Mahindra & Mahindra. That implies an upside of nearly 42% from current levels. Then 8th stock in the list is from hospital sector. The key growth driver for hospital sector include under-penetrated private hospital market, which is still highly unorganized. Then senior population is growing at a faster rate, followed with rising income and higher insurance penetration that is improving affordability. Having said this, there are some risks around high capex for hospital companies, then rising competitive intensity, especially in key micro markets, and potential pushback on rapidly rising ARPOB, that is average revenue per occupied bed, along with inflated valuation multiples for hospital stocks. So going forward from FY26, this ARPOB growth would normalize to mid-single digit. Considering both risk and reward, Goldman team like Apollo Hospital in this space. First reason is continued ramp up of occupancy. Apollo occupancy last year was 66%. It got improved to 68% in December 24 and management has guided for 70% occupancy in FY26. Improved occupancy would lead to operating leverage benefit of 50 to 100 basis points at the existing hospital. Then second reason is break even at Apollo 24/7. Apollo 24/7 is the digital healthcare platform of Apollo Hospital that offers service like online consultation, medicine delivery, and diagnostic test. It leverages extensive network of more than 6,000 Apollo pharmacies in India to fulfill medical delivery and related service. While there is a slowdown in growth of online platform, it is expected that Apollo 24/7 is on track to break even in the next 3 to 4 quarters on the back of new strategies, initiatives, and cost optimization measures. Also, Apollo Hospital is expanding its diagnostic center with a target to reach 1,000 crore diagnostic revenue in next 2 to 3 years. Due to all these factors, Apollo's EBITDA is expected to grow at 26% CAGR over FY24 to 27. Based on that, Goldman research team has given a target of 8,025 on Apollo Hospital, implying an upside of around 18% from current levels. Then final stock is from power sector. It's Power Grid. As India scale up its hybrid renewable projects, grid expansion must outpace generation capacity to maintain system reliability, reinforcing the structural need for overbuilding the grid. That's where Power Grid would be the largest beneficiary of this trend due to its strong balance sheet, low cost of debt, and superior execution capability, positioning it to capture a sustainable share of upcoming transmission projects. Goldman research team has given a target of 375 rupee on Power Grid, implying an upside of around 22% from current levels. So in this video, we discussed the top stocks from Goldman Sachs report in current market situation. It includes HDFC Bank, EU Small Finance, Titan, Godrej Consumer, Adani Port, Interglobe Aviation, Mahindra & Mahindra, Apollo Hospital, and Power Grid. Now tell me in the comments which stock from this list is part of your portfolio. And if you want to track your stock portfolio performance against the benchmark, you can explore Deserve Wealth Monitor app. Link I provided in the description. So this is it for this video. I'll see you in next video. Till then, take care. The views and opinions expressed are my own and does not reflect or represent the views and position of Deserve Investment Private Limited or its affiliates. The information contained in this video is for general and information purpose only and is not meant for advisory or recommendation purpose.